All right, what's up, guys? So I'm gonna make a video about some more unconventional trades that I do personally. Um, so yeah, let's get into it. This is just a paper account. Probably, if this channel does good, I'll probably start showing my actual trading account. But for now, I'm just gonna stick with this. So, um, recently, as you can see in the bottom right down here, it's August 9th. I've been focusing on getting long volatility because well, vols mean reverting, right? So go to the VIX. Here it is. We're down here to 15 handle. Uh, Most of the time, the VIX is uh, I don't know why it does it like this, but trading view is a lot better. But if we do like like a long ass fucking monthly chart, basically, um, you can see going back to 2010 or 2011. I'm sorry. Uh, you kind of like put the cursor here at 15, you can see most of the time ball is above the 15 handle. Sometimes it's not. It's been down as low as 856, but most of the time it's above it. So we want, I mean, in my opinion, right now the edge is in looking for long vol trades. What's a long vol trade? Probably the best long vol trade is a straddle. It has the highest Vega exposure, so your sensitivity to volatility. And because, just a quick lesson in VIX, because VIX is derived from the S&P, the SPX 30-day options, the best product to do it in is SPX or XSP, which is a tenth the size of SPX, cash settled. Cash settled meaning you don't have to worry about assignment of the shares for both products, SPX and XSP. So anyway, so let's just structure something in XSP because most people are going to have a smaller account. That's just fine. So you have the balance between time and Vega, I guess. Well, time and premium, essentially. So, like, okay, you go to the August 9th, right? I'm just picking one. I think it's the 15th is yeah, that's the actual monthly expiration. You always want to watch for open interest, volume. Want to make sure that the spreads aren't gonna destroy you, and there's decent liquidity. XSP has less liquidity than SPX, but like an at the money straddle is literally that you buy a put at the money and you buy a call at the money, and it's called an at the money straddle. Generally corresponds to the expected move. The debit you paid corresponds to the expected move. So you're betting on a larger than expected move if you're going to profit in delta. I'll talk about that. So what does that mean? So if we analyze this trade, okay, what's going on here? So if we analyze this trade, we can see our risk profile. And you might be thinking like, bruh, like what is this risk profile? This doesn't even make any sense. You're basically just giving away $830 because you need this to, if expiration, when's expiration? August 15th. There's your expiration, the day after, and you need it to get above that or above that by expiration to profit on the delta. Now, that this isn't a delta play, at least in my opinion. This is a vol play. What you're this is what you're expecting. Like, this is today. I mean, you can't buy it today, but let's just pretend you could. So you're marked it at 0, right? Like you can see over here. This is the profit on August 9th, the profit on the 16th when it expires. This orange line's current price. You can see you're marked at 0. Okay, cool. So what's the point of this trade? You're looking for a vol expansion. You can see that this is the volatility of each, the call and the put. And then if you go over here, let me see. Do I have a watch list? I don't really use this, so it's like kind of all jacked. You have these are all just futures. Trying to pull up the VIX. Here's the VIX future, right? 1675. Real VIX is like 15 something. So if you have any sort of volatility, and you say we go from 15 to 20, which is really not even that crazy. That's 5 points of vol. Watch what happens to the purple line, because the purple line, okay, dude. Purple line is the line that you are looking for. Rises up, even if the stock doesn't move. $300 of profit. It's because of this Vega. This is a long 65 Vega. So if you go here, and we're in our position. By the way, I wouldn't recommend going this short in duration. I'm just talking about this right now as an example. For Vega exposure, I would show you what I would actually do and what I have on right now. But you're long 32 Vega on put side, and you're long to do 33 Vega on the call side. So add it together, right? Cool, 65. And this is 65 Vega. So essentially, this has a lot of theta because it's so close to expiration. You're gonna lose $100 a day. Your delta somewhat neutral. You're long 8 shares. Whoop-de-doo. Gamma as well. It's a high, it is a high gamma because it makes more money as it moves because it's so close to at the money. And you get 65 Vega. So you're hoping for this. So how I would structure something like this to be more long vol appropriately, although it's more expensive, is I bought the January in my account, and I went to at the money. I think I did it on SPY though in my own account personally. I mean, because you don't have that much of an assignment risk when you're longing options. You're not shorting anything. So we'll just look at SPY. It has better liquidity anyway. So SPY at the money, buy. Get these out of here. About $5,000 debit, and this is what you're looking at. So now the Greeks are much better in our favor, in my opinion. You have 18 delta, so you're long 18 shares. 16 theta, lose $16 a day, but look at your Vega, $324 per point in the VIX. So now, if we hit the vol adjustment, and even if you get that 5-point pop back to 20, you're up 1600, it depending on where it goes, right? If we get a 5 pop in the VIX, more than likely we've moved down. How far? These slices are set at 10%. So this is current price, that's down 10, that's up 10. We're gonna move down. Well, if we move down 10, the VIX is going a lot higher, right? But if we move down whatever, I don't know, 3%, right? You're gonna get a VIX pop. So you're gonna be coming down here, and where this strategy really goes crazy is if you're long a straddle and you get a pop, say you get a 15 vol pop, and VIX goes to 30 because the orange man's in the office and he's really doing it hard. We're shoving way down, and we're not paying attention to the blue line. Blue line's at expiration in January. We're paying attention to the purple line. And so you're up significantly on a vol increase, which is theoretically just moving VIX back to more normal. Let me put this back on. Go back to our 5-year 1 day or daily, which is theoretically just a push back to normal volatility. Something like, I think the market average is like 20 or something over the last 5 years or so. You can look it up. I don't exactly know. It is higher than 15. So, if you did something crazy and moved back up into the 60 handle or 40 handle, or even over here into the mid 30 handle, the delta exposure on the trade is giving you profit because you're ripping here. So that's giving you profit, but you're mainly catching all this Vega, and you have a lot of Vega with a long straddle. So it's a really good strategy that I like. Risk management's a thing because theta decays. It decays your thing, right? So you're gonna lose. You're losing $30 a day. I thought it was 16. That must have been the other one. But or maybe it's because of the vol pop. Let's see. Yeah. So theta is a real thing that is going to decay this option down. So like pretend, so we have this until January. I'm just going to make some shit up. Pretend we go through all of August, all of September, and we go to November 18th, right? So we've lost $2,000 just the theta. So, and vol can even come down. Like vol can go, I'm just showing you the risks associated with this trade. Vol can go down 5 more points. And we could be into a 10 handle. Is that likely? No, but it could happen. I mean, we've seen it as low as 8, so we could be down 7, and vol could be at historic lows. And if you're not going long vol at 8 handle on the VIX, you're fucking insane. Like that's 100% where you need to be going long vol. Anyway, but you know this thing could draw down near your max loss of like $5,000 and be down 3,400, and to vol and theta decay, but. Pretend that Orange Man, instead of vol going down, not to confuse you, pretend we've stayed at a 15 handle until November, and he tweets that, you know, he's gonna, I don't know, tariff everything in the world to $1 million, and we get that pop and vol that we're looking for, that 15. Well, now you're presumably, say the market is still pegged at this exact same price, 638. On the S&Ps, not likely, right? But you get that vol pop. Now we're into about 30 on the VIX, and we're up $1,000. But more than likely, we're down somewhere, right? We got to be down if VIX is going up, or we're up more because VIX is gone low. So we're catching some sort of delta exposure. So it's when VIX is 15 handle and at the money straddle on major indexes is. Yes, you could lose 5,000 if the index pegs here and does nothing but trade flat, just flat line. If SPY just or SPX, it's SPY, same thing. If it just sits here and we trade flat in a flat line, like it never does. But if we did, pretend we did, that's how you would lose your $5,000. Okay, but statistically, with VIX this low and markets at all-time highs, volatility's coming. Or the market keeps ripping up and volatility goes down, but it's okay because you catch all of this. Look at, we go to 820. It doesn't matter. Vol can go down 7. Doesn't matter. Look, vol can go down 7, and it can be October 15th, and we're at 820. Doesn't matter. You're up 13,000. Right? Doesn't matter. And if vol goes down, if we drop 30%, I don't even know where that would be, somewhere out here, and vol shoots to 40, you're up 10,000, right? So like it's or I mean you go, or we rip up to 810 and drop here, and then we land in this range because you know from 810 down to here is a 20% some odd drop, and vol shoots up and you're in this range. So it's a very, very high probability trade that people don't talk about because most traders are focused on directional exposure, delta, where's the S&P gonna go, sell a put here, support, a thing, cover, oh, double top, sell a call, whatever. It's just another way that's less looked at, less competitive to make money trading vol. So there's my short video on at the money straddles to catch long vol in the market when vol is this low. So hope it helps. I'm probably gonna make some more of these videos, try and keep them short, explaining different trades. So yeah, thanks.